Welcome to The Explainer. Today, we're jumping into a trading philosophy that gets a lot of talk online, but can be pretty confusing. ICT, or Inner Circle Trader. We're going to get straight to the source and break down its core ideas on how the market really works.
Okay, let's just start with a fundamental question. When you look at a price chart, what are you actually seeing? Is it just chaos, a totally random mix of people buying and selling all over the world? Just unpredictable noise?
Well, the entire foundation of the ICT method says, no way. It argues that what we're watching, especially in the Forex markets, isn't some free-for-all auction. It's the product of something called an interbank price delivery algorithm. Basically, a pre-written script that's dictating where price is headed and why. So, how in the world do you decode a script like that? Well, we're going to tackle it in 5 parts. First, we'll get into what this price algorithm is all about. Then we'll cover the only 2 questions you supposedly ever need to ask. After that, we'll look at the 4 states the market can be in, how to connect those states to a real strategy, and finally, wrap up with the power of finding your one signature setup.
So, this algorithm, what's the deal? The idea here is that the old days of traders yelling in a pit are long gone. It's all electronic now. And from this viewpoint, that means it's highly engineered, maybe even manipulated. The algorithm's one job is to deliver price from one level to another as efficiently as possible, and as it does that, it leaves behind what you could call fingerprints, little clues for traders who know what to look for.
So how do you even begin to read these fingerprints? Well, the ICT method boils everything down to just 2 simple questions. Get the answers to these, and you've got the foundation for any potential trade. And you know what? These 2 questions are incredibly simple. First, what's the market context? That's the why. It's about figuring out the story the market is telling right now. And second, what are the institutional reference points? That's the where, the exact price levels that this algorithm is aiming for. Okay, so let's dig into that first piece of the puzzle, the why. According to this philosophy, the market can only ever be in one of 4 distinct states at any given time. If you can identify the current state, you've got your context.
Everything starts with consolidation. You've seen this. It's when price is just chopping sideways, not really going anywhere. It looks boring, right? But underneath, the theory is that the algorithm is hard at work, building up buy orders and sell orders, essentially coiling the spring for the next big move.
And then, after that coiling, you get the expansion. This is the explosion. Price shoots out of that sideways box with real speed and power. And this is your first huge clue. It's like the market is finally showing its hand, revealing which direction it actually wants to go.
Now, after a huge, fast move, you'll often see a retracement. It's a pullback. Price kind of drifts back into the area it just broke out of. This isn't random, though. The idea is that price moved so fast, it left behind inefficiencies, gaps that the algorithm wants to go back and fill. For a trader, this is like a second chance to hop on board the move you might have missed.
And finally, we have the reversal. Now, this is not just a little pullback. This is a complete U-turn in the market's main direction. This tends to happen after the algorithm has hit a major target, like taking out a big cluster of stop-loss orders that were sitting just above an old high or below an old low.
Okay, so we can identify the state of the market. That's our why. But how do we pinpoint the where? This is where we start connecting the dots. We can actually pair each of those 4 states with a specific institutional reference point, or as ICT calls it, a tool. So when the market is in consolidation, the key level to watch is the equilibrium. That's just the 50% level, the exact midpoint of that sideways range. It acts like a magnet, and the algorithm often uses it as a final launch pad before it sends price blasting off in one direction or the other.
Now, when we get that big expansion move, the tool we're looking for is called an order block. So what is it? It's simply the last down candle before a strong up move, or the last up candle before a strong down move. The theory is that major institutional orders were placed there, making it a super significant level that price might want to test again before continuing on its way. During a retracement, what's the market doing? It's often trying to fix sloppy pricing. The tool for this is the fair value gap. Imagine price moves so fast it leaves, well, a gap, an empty space on the chart. That gap acts like a vacuum, and the algorithm is often drawn back to that void to fill it in and make things efficient again. And for a reversal, the main tool is liquidity pools.
So picture all the traders who set their stop losses just above a clear high or just below a clear low. All those stops bunched together, that's a liquidity pool. Once the algorithm sweeps in and triggers all those stops, it often is the fuel it needs to turn the ship around and head in the complete opposite direction. All right, so we've got the states and we've got the tools. But how does someone who's still learning actually use all this without getting totally overwhelmed? And that brings us to what might be the most practical part of this whole philosophy. When you lay it all out, you can really see the story the market tells, over and over again. First, it builds orders and consolidation. Then, an expansion move reveals its intent. That's usually followed by a retracement, which gives you a great spot to potentially enter. And finally, you get the next leg of the move toward a new target. It's a logical, repeatable cycle. But here it is. This is the most important piece of advice in the whole approach. You do not need to become a master of trading consolidations and expansions and retracements and reversals. In fact, trying to do everything at once is probably the fastest way to get nowhere. The source material is really clear on this. It says it only takes one setup. You can start being consistently profitable in your trading. The goal isn't to catch every single move the market makes. The real goal is to find your one bread and butter setup, the one part of this cycle that just clicks for you, and become an expert at that one thing. So all of this really leaves you with a big final thought to chew on. If the market really does follow a script, if it repeats this four-stage cycle again and again, then maybe our job as traders isn't to predict the future. Maybe it's just about getting really, really good at recognizing the patterns the algorithm leaves behind as it writes the story of price.